Well, what did I tell you? This was coming sooner or later, and it looks like it is starting to happen now. We are seeing U.S. job openings fall. They're now at a 9-month low, even though the news is still trying to spin it as if the labor market is still tight. Things are changing very quickly. Ready? Let's dive in. Today's sponsor is Moomoo. If you haven't heard of Moomoo, they are my new favorite app for advanced investors and traders. So who are they? Well, number one, Moomoo is a NASDAQ listed company. They are founded in 2018. They're basically a fintech company, and they have now more than 18 million users from all around the world. Their market cap is just about $7 billion. And the reason why they've been able to grow so quickly and attract so many users from all around the world is because of the free access to some of these advanced tools that many other platforms will not give to you. And that honestly is the reason why I like Moomoo. They're democratizing access to these professional level trading tools, making them available to individual investors. One of my favorite tools that they give you access to is Level 2 Data. You can see I've got it pulled up right here. Level 2 Data gives you access to see the market depth. And so you can see this green side on the left and the red side on the right. Those are all of the outstanding open limit orders there. So you can see this is especially useful on a security that is low volume. You don't want to just go throw in a market order and hope for the best, hope it doesn't move the market. With Level 2 Data, you can see where open orders are sitting so that you know where to place your orders so that you don't move the market, how many shares to buy or sell depending on what the liquidity is at that moment. You can see it right away here with this Level 2 Data. You can see that market depth, absolutely essential tools. And my other favorite tool that they have is the ability to track institutional portfolios. If you see here under markets, you go to institutional tracking, you can see some of the large institutions that they track like Berkshire Hathaway, Soros, you can even go into Bridgewater, so let's go there. And you can see right here that they list the top buys. Right now it's Medtronic, Berkshire Hathaway, Caterpillar. You can even see their top holdings lists. And when you scroll over, you can see how large that position is in their overall portfolio. Absolutely powerful tools here again that they're making available to individual investors. You can follow the big money, copy the big boys, and just ride that wave. So I like Moomoo, and if you use my link in the description below to sign up, you can get 5 free stocks worth up to $2,500 per share. Sign up for Moomoo using the link below today. Well, you guys have known that I've been saying this for a while now, but for a quick recap, in 2020, when everything fell apart, they started handing out money like crazy. We started to see job churn at a pace that we haven't seen in this country ever. And what happened was, in my opinion, retrospectively, people got a little bit of a boost that gave them the courage to quit the job that they never wanted in the first place. And so people got a little bit of a stimulus check. Their asset prices started to go up. They got a lower expenses from refinancing their mortgage at a lower rate. And so they have more income to devote to other things. A lot of people took the mortgage forbearance. And so for a period of time, for a year, 18 months, nobody had to pay their mortgage. So there were all of these things, and the cash out refinances too, big lump sum in their bank account, all these things that allowed many Americans the opportunity to just say, screw it. I hate this job. I've hated it for years. I've never had an opportunity to leave. I'm finally going to do it. And because everybody started doing this, all these job openings had to start popping up to fill those spots. And in order to do that, you got to pay more. So they had to start paying more to attract people. And as that kept on happening, that churn just kept the wheel going, where people were able to continue to leave for other positions that were better, that paid more. And you had this churn start. And that's why all of the quittings didn't result in a massive amount of a drop in the labor force participation continuing, because people kept on going and getting other jobs. And so that was the main thing people were worried about in terms of inflation. We're saying, hey, we won't have inflation from the stimmy checks because people will just spend it and then it'll go back to normal. The only way you can have inflation is through sustained wage growth. Well, guess what? We got the sustained wage growth. Was it as much as inflation? No. But was it enough to keep inflation going? Absolutely. And so once this wage growth continued and became apparent that it was continuing, the Federal Reserve finally said, okay, well, we need to do something to fight inflation. And normally the jobs market and inflation are at odds with each other for their monetary policy. So if they say we're going to tighten, that'll hurt the jobs market. So we're going to favor the jobs market and oh, well, if there's a little bit of inflation. But now inflation is shot through the roof. It's at record highs, decade record highs, and job openings have continued to be high. And so they're saying, hey, well, look, yes, there's a lot of people on unemployment, but there's still a ton of job openings. So we can't really complain about the jobs market because these people just aren't taking jobs. So we're going to fight inflation until the jobs numbers say we can't fight inflation anymore. Well, it's starting to happen. We're starting to see these deflationary forces hit the economy from the lack of the growth in the money supply that has happened since the beginning of this year. Businesses are starting to shut down. I've started to show you data over the last few months of, hey, companies are starting to lay people off. This will lead to other big companies starting to freeze hiring, take those job postings down, will lead to other companies having to lay off and so on and so forth. It's putting a stop to that wage price spiral. And we can see here that the US job openings fell by the most in just over 2 years in June as demand for workers eased. Now, it also says that the labor market remains tight, which allows the Federal Reserve to continue raising rates. And it's tight because there's still 10.7 million job openings in June. It dropped 605,000, which was a massive drop historically, but there's still 10 million jobs available. But now I want to show you a chart that is a little bit more frightening than just looking at, oh, we lost 605,000 job openings, but there's still 10 million. What's the big deal? Take a look at this chart. This was posted by Tavi Costa from Crescat Capital. Right now, we are experiencing the largest 3-month decline in job openings in the history of this data, which goes back to 2001, and it only excludes 2020 at the beginning there when we had an immediate time period afterwards where it skyrocketed the other way. And so when we look at what is happening right now in the change in job openings, it is staggering. We have never before had anything that has gone down this low outside of the beginning of 2020. Now, considering the fact that we are still at 10 million job openings right now, let's say this continues, because it likely will, because we'll likely continue to enter tighter and tighter conditions with the Federal Reserve continuing to raise rates. Maybe they don't do 75 basis points every time. Maybe they go down to 50 basis points, then 25 basis points in what I call dis-tightening. Remember that, because it's like disinflation is lowering rates of inflation even though prices are still going up. Dis-tightening is lowering rates of tightening even though rates are still going up. And so if we have this continue, we're going to have these deflationary forces build up on the economy. Debt service costs get higher and higher, become harder and harder for Americans to live. It's not going to do much to inflation, at least at first. And so we're going to see tightening down. Job openings then could dry up. And if job openings dry up and they cease, then we start to move into a massive wave of unemployment. At that time, this is where things get really interesting, because this is the one metric that the Federal Reserve is using to say they're justified in fighting inflation. They're saying the economy is still strong because we have job openings. But what happens when very quickly this could turn into no job openings? This could start going the other way very quickly, and it likely will, because we're going to continue tightening until it gets there. So what happens when the Federal Reserve looks up from their table of decades old data and says, whoa, what happened? We've got no job openings and inflation is still at 8%, still at 7%. Or 10% or 6%. What are they going to do at that point? Because now they can't say the economy is strong anymore, because the only indication they had for the economy being strong was job openings. And so if they can't point to that anymore, but we still have high inflation, the big question is, what are they going to do? Now, you and I probably both have our opinions about what they're going to do at that point. And if you're watching this channel, you're likely on the same camp that they'll probably pivot, get easier. They'll try and soften the blow. They'll choose trying to save the economy instead of saving the dollar. We will see. I would be inclined to think that as well, as long as we have some sort of systemic risk that comes along. If the only thing we have is increasing unemployment, my bet is still that they take a little bit longer to pivot. However, that is the one indicator that they have. The job openings are just the one indicator that they have that the economy is strong. So if they don't have that anymore, it's going to be very politically unpopular for them to continue to tighten and fight inflation. Regardless of how bad people hate inflation, people want jobs. That's kind of the way of the sheep. You'd rather have a job and you'd rather have a guaranteed little loss instead of the chance of a large loss. And so we're likely to see some political push if the Fed continues to try and tighten into job openings completely drying up. We'll see what happens. I will keep you updated, but as of right now, the tide is turning quick and we are seeing job openings dry up very quickly. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.